Welcome to our 2016 webinar series. This year, timing is everything. This year, we'll be telling your clients' stories just when you need to hear them and share them with your clients. After all, when you tell a story, makes all the difference. If I told the story of the three little pigs to a group of 5-year-olds, it would be a fable. If I told the story of the three little pigs to a group of general contractors at a conference, it would be a case study. And if I told the story of the three little pigs at a summer campfire with a bunch of preteens, it would be a scary Cujo story. And if I told the story of the three little pigs on a first date, well, there probably wouldn't be a second date. Each month, we'll tackle fears your clients have about income security and wealth preservation using innovative and creative insurance solutions. This month, we'll highlight the need of long-term care insurance and recognizing November is Long-Term Care Insurance Awareness Month. Each month's series will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's story is being recorded and will be posted on our website within a week in case you missed any of the plotline. And throughout 2016, like the saying, the more you read, the more you know. The more you watch, the more CFP CE credits you'll earn. You can get 8 credits, 1 for each month. Today's storyteller reads a lot, constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA, and has been writing the LLIS story as president and CEO since 2013. And here's Mark Mallon.
Thank you, Claudia. And I was going to start off with some political jokes. Claudia said, please don't do that. So unfortunately, I'm about 30 minutes short. But sorry. For everyone who did vote, thank you very much for doing your civic duty today. And tomorrow, whatever happens, let's all remember we're all on the same team. But today we want to talk about long-term care and long-term care insurance because it is LTCI Awareness Month. No matter what happens in life, we continue to get older, and that's just a fact of life. And the costs associated with needing care later in life continue to increase. How important is this? 70% of Americans who reach age 65 will eventually need some form of long-term care. And if you see there in the bottom left, this is from the U.S. Department of Health and Human Services. It's not from an insurance company. It's not from someone designed who's selling long-term care policies. It's U.S. government that says 70% of people who reach age 65 are going to need care of some kind. And that's a concern as we have more and more people turning age 65 than we ever have before. In 20 years, for a couple who's 65 years old today, it's expected that their costs of paying for care is over $220,000 throughout the course of their retirement. That's a lot of money when we think that most people have pretty good retirement plans when they get to 65. If this does this, that does that, all of these things work pretty well, but we don't have big swings. We don't have big changes, big expenditures. $220,000 is a big expenditure to me. So it's important to plan for this. I was doing, as Claudia mentioned, I do a lot of reading. And one of the things I found here recently was a study about how insurance companies have gone and looked at pricing their long-term care insurance policies. And so I wanted to share that with everybody because I think it's new, it's interesting. It's something you probably haven't heard of before. And we're going to go into some claims experience, some claims information, and some case studies, because no matter what I tell you about what this costs and it costs here and the premiums here and the expenses there, until we put it into real people, your clients, it's just a bunch of numbers. But until you see those are your friends, those are your clients, this may be you, then that's when a lot of this becomes real. And I love this slide because any pricing of almost anything is a tightrope. It's a tightrope walk. Long-term care insurance, probably even more so than a lot of different things, because in the world of insurance, it still is sort of the new kid on the block. We have life insurance statistics that go back decades and decades, if not hundreds of years by now. Assisted living facilities, barely existed 20 or 30 years ago. So insurance companies are walking this tightrope of how do they price long-term care policies to make them affordable today, reliable, and potential to have little to no increases in the future. So in 2015, 6 insurance companies participated in this study, and in order to get the invite, you had to have been issuing long-term care insurance policies before 2000 and still currently issuing new policies. And for those of you who have been around for a while, you know that in the 80s and 90s there were lots of insurance companies and everybody was getting into the long-term care business. And over time, the smaller companies were purchased by larger ones. Fortis was purchased by John Hancock, for example. It's just one I happen to remember. So lots of smaller companies were in it. Other companies, MetLife, Guardian, were in it for a little bit and decided to not stay in the business. So you have 6 companies that have been around for a long time, still issuing policies. And they looked at pricing assumptions for their portfolios and benefits of 3 issue dates. So looking at policies that they'd priced and issued in 2000, 2007, and 2014. Remember where I said that long-term care is still the new kid on the block. In 2014, the insurance companies had 16 times the amount of claims data that they did in 2000. So you see policy data years, instead of 400, having 400 years of policies on the, that they could look back and know how to price. In 2014, they almost had 7 million. This is a really big one. We aren't too concerned about the pricing on people in their 40s and 50s as we are for people in their 80s. A lot of times that's when we expect most of the claims to happen. And so in 2014, they had 70 times the data and years of experience of people who were over age 80 and how those people are going to go on claims or go on claim. So the study basically said just in these last 14 years, we have multiple times the amount of data that we need to better price policies going forward. So how did the costs increase based on those existing policies? Well, for the same person, and not what a 55-year-old in 2000 and a 62-year-old in 2007, but a 55-year-old walking in the door could have gotten a particular policy for $11.25. 7 years later, a new 55-year-old would have paid $12.50, and in 2014, a new 55-year-old would have paid $21.50. So what we can see is in 7 years, there was very little change, not very much at all. From 2007 to 2014, we had a lot more claims experience. The first 7 years, while it was 7 years, as you saw on those other slides, the number of policy years hadn't gone up that much. To go from 2007 to 2014, it exploded. And what they saw was, based on that much more claims experience, 2000 and 2007 policies were underpriced. Most things go up in life, and I wanted to look at what was the cost of gas per gallon at those same 3 years. The long-term care premiums from 2000 to 2014, it increased about 4.74%. Cost of gas, it increased almost 6% every year over the course of that time. So things increase. It's not too much of a surprise, but I'm hopeful that going forward, we're going to have less and less surprises as far as the pricing goes. So when insurance company actuary and all their people are pricing a long-term care policy, their number one concern is morbidity. Morbidity is what is the likelihood of somebody still being alive but needing help with 2 of the 6 activities of daily living, or having a cognitive impairment where this person may need hands-on or standby assistance doing their normal activities of life. So insurance company for a long-term care policy is looking at morbidity, not mortality, which is for life insurance, we're going to touch on in just a second, which is why sometimes you may have people who are eligible for life insurance but not eligible for long-term care. The same thing that may make you not able to do things as you get older may not be the thing that's going to kill you. The investments. An insurance company collects premiums, invests them, and then uses those to pay out claims at some future date. The morbidity is, when am I going to be paying out those claims? What's my expectation? The investments, obviously, as you know, what is the insurance company going to earn? Well, if we go back to 2007, I don't know if anyone would have predicted interest rates would have been as low as they are and have been for as long as they have been. I think that made sense. But every year that goes by, there's not this, oh sure, 5% makes sense. Oh sure, 5% makes sense. A lot of companies have looked at these investments and said, 5%, that was great when we had it. We need to have a lower long-term investment assumption. Voluntary lapse rates. I think this is a really large one in the pricing from where you saw from 2000 to 2007 and again in 2014. When the policies were originally priced, insurance company built in lapse assumptions like life insurance, which depending on what you see is anywhere from 5% or a little bit higher of policies that just lapse. When you have term, it's because you've outlived the term. If it's universal life, it's because you had 3 and you didn't need one anymore, or premiums got too high, maybe all these different things. Long-term care lapse assumptions are close to less than 0.5%. And so insurance companies said, we're going to collect these premiums. We know that half of these are just going to lapse, and so we can basically collect a little bit less premium because we know some of these policies are just going to lapse. People don't lapse their long-term care policies like they do life insurance. I'd say of all the policies, long-term care policies I reviewed in the last 2 years, even with rate increases, you can't get a comparable policy today for somebody's policy that was issued a few years ago, even with 30 or 40% rate increase. Premiums are almost double today. So voluntary lapse rates are very, very low, and that's part of what some of the pricing difference was in the past. Mortality, again, I have to take this into consideration because if somebody's deceased, I don't have to pay a long-term care claim. But I'm not as concerned about that as I am with some of the other things. Commission expenses, insurance companies are looking at how they pay out commissions, what commissions are paid out compared to premiums going in. So again, that's part of the overall pricing. And administrative expenses. Again, what are the costs to issue policies, pay claims? All of those are built into the policies. And I said to pay claims because all of this leads into the next part, which talks about claims. I collect the money, I invest the money to the end goal of paying out claims. And that's another part of why some of these changes and some of these differences. So for new policies issued today, insurance companies have a much better handle on the likelihood of claims. And it just comes from that 16 times amount of claims data, or 70% for people over age 80. So every year that goes by, we have changes in medicine, things that may prolong life, even though you may not be able to do things in that life, but things that prolong life. So insurance companies every year that goes by have a better understanding of morbidity. Insurance companies had a really good understanding of morbidity up to age 65. That's called disability insurance. But going back to 2000, their understanding of morbidity for people in 2000 was much, much less than it was 2 or 3 years ago, because they have 16 times the amount of data for normal people, for not normal people, the whole population, and 70% more for people over age 80. So they have a much better understanding of morbidity, the likelihood of paying out claims, the amount of claims, the longevity of a claim. They've built in those rock bottom lapse assumptions. They're saying when we issue a policy, we really can't assume that some of these aren't going to be there to pay claims. We basically have to assume that almost all of these are going to be there, and we're going to have to pay claims on them at some point. And I have to assume that when I collect the premiums, I have to invest that at today's interest rates for a prolonged period of time. I can't say, we'll still, assume we're going to earn 5% over the long term. It's not the world we live in today. And so these 6 companies and the study that came out of it indicated that policies priced today, given these new updated information, a lot more claims experience. Policies built in, assuming they're not going to lapse. Policies built in price today with low earnings assumptions. Is that policies going forward from today have a very low probability of rate increase, probably 10%, compared to policies from 2007 and policies from 2000. So where are claims being paid? I thought this was interesting. It just sort of backs up what I think a lot of us think, is that most people would, given the choice, prefer to receive care in their home. So people are receiving care in their home. Where are claims being paid? 52% of claims are being paid in the home. Another 20% in assisted living facility. So only about 30% of long-term care insurance claims that are being paid to a skilled nursing home facility. 70% is in the assisted living home care areas. And this doesn't cover the millions of hours and billions of unpaid dollars that kids are taking care of their parents at home. So all of that is built in. They're not built into that, because I think the number of people who need care, where are they receiving it, is probably even much higher at home, but it's unreported because it's just things that husbands taking care of wives, wives taking care of husbands, kids taking care of parents. And from a Genworth claims data report, said more than 70% of their claimants are seeking home care services. So in Tampa, what are the things when I look at and think of home care? It's really almost anything besides skilled facility. So you have home care, homemaker services, which can be somebody who comes in, maybe does a little light cleaning, light cooking, but also is there sort of as a companion. Home health aide, a little more skilled, is going to be a little more like the person there in the picture, helping with the transferring, the bathing. Out of home care. Not quite home care, it's out of home care. This is an adult daycare where a parent, a spouse may still be living at home, but somebody needs to go to work. And so while they're at work, somebody's in a group, usually a group setting, group adult daycare, $1,200 a month. An assisted living facility, private 1-bedroom, $3,350 a month. Now again, this to me still sort of falls under the home care, non-skilled care. And you may, someone may receive skilled care in an assisted living facility. Here in Florida, we have lots of places that are called continuous care. You may start off at a condo or an apartment, move to an assisted living facility where maybe the transferring and some of those things are trickier. Eventually getting to the nursing home where you have skilled care, skilled nurses, physicians doing a lot more ongoing monitoring. And as you might imagine, the costs for that are much higher, almost double all of the other options, because the amount of training, education, facilities to provide that sort of care there is going to be that much higher. And are their costs increasing? Not like they used to. It wasn't that long ago that the costs for almost all of these were in the 4 to 5% compounding range. The homemaker services, the adult daycare, in the 2 to 3% increase. Private 1-bedroom, still again a little bit less than 3. Even for the skilled, not quite 4% on any of these. There was a period of time when the number of people who needed care was much higher than the availability of people to do it, and so the costs ramped up a lot. Today, again, I live in Florida. There are a lot of places that people can go to, drive by a lot of them. And so the availability, people who were, even on the radio, I hear nursing colleges and ways to get your nursing degree in 2 years. So the availability and people who are going into these sort of health-related services is increasing as well. So the costs haven't increased quite as much as they have in the past. And I thought this was a particularly interesting part of that Genworth in-depth claim study that says they looked at how much benefit a person has in their policy. And they found that people are using only about 67% of the benefits of the policy. So with a life insurance policy, you use 100% of the benefits because you're either alive or you're not. And if you're not, then somebody gets 100% of the policy. The long-term care policies have monthly benefits and total pool caps. So you may be able to receive $4,000 a month for 4 years, but they're finding that people aren't using all 4 years, and they aren't using all $4,000 a month. They might be using $3,000 a month for 4 years, or they might only be using 3 years of their 4 years of benefits. So they're finding that claimants are only using less than 70% of their benefits. And so I took this and I thought, maybe there's an idea there of, maybe there's different levels of wanting long-term care insurance and levels of wanting long-term care protection that may fit different clients and different needs, especially knowing that not everybody and maybe not most people really need a policy that will cover lifetime benefits for 100% of the skilled nursing home benefits available in their area. So going with that, I want to look at a couple case studies. Here we have Daryl and Ellen, both age 53, and they're loving life in the sunshine here in Tampa, Florida. It is a beautiful day here today, so it's particularly appropriate today. They're looking at long-term care coverage. Their advisor had asked them to look into this because it's part of their planning. They're in their mid-50s. It's about the time when people start looking at long-term care insurance and how to plan for needing long-term care. They're many times on the other side of I'm worried about having enough in retirement to I'm worried about spending down what I have in retirement. Also, people in their mid-50s are about the right age when they're having to care for a parent, or they may have a cousin who's taking care of their aunt or uncle. So this mid-50s range is a time when I think it becomes really relevant to a lot of people because they're seeing it firsthand and are looking at, I can see retirement and I can see what happens 20 or 30 years down the road now that I didn't do when I was 35. And so Daryl and Ellen are particularly good people to think about this right now. And they have a house, they have some cars, they have some money, they have some assets, they have some retirement income. So they're doing fine. And they're looking at all of this saying we're pretty good. We feel pretty comfortable with retirement. But we've seen things that the cost of care, if we need care in the future is 20 years from now is $220,000. Well, we'll only be 73. What will it be if we're 83? And so, like I mentioned before, everything goes along pretty fine if we don't have these big swings or changes. Oh, I have an advisor ask a question. Regarding the monthly costs of the various levels of service, do you have information for other regions? For example, San Francisco, the other Bay Area. Well, I don't know what the other Bay Area, I think I'll take the Bucks any day. But yes, we do. Give me a call or Joe McNeil here in our office, and we have software and data that we can pull up for all of those different levels of care, the home care, the assisted living facility, all of those things. So Daryl and Ellen here in Tampa looking at all of these different options. And what we looked at for Daryl and Ellen is let's look at kind of a base plan, knowing that 70% of people want to receive care in their homes. And 70% of people don't use all of the benefits available to them. What if we, at first, don't look at using a policy based on nursing home coverage and all of these larger amounts? What if we design a policy that says 70% of people want to receive care in their home and people have policies with unused benefits? What if we design a policy that they're most likely to use and even use 100% of? And so it's a good base that's going to cover, on my example, 3 of the 4 grids here. Sorry, clicking malfunction. And so we looked at a policy for Daryl and Ellen that had $3,800 of monthly benefits. So if they needed care, that's going to cover adult daycare, costs here in Tampa of adult daycare, assisted living facility, home health aid. So a policy that may cover all of the benefits, all of the costs for what 70% of people are using their policies for. We used a 3-year benefit period each with the shared care rider. So Daryl has a 3-year benefit period policy. Ellen has a 3-year benefit period policy. With this shared care rider, it creates a pool of 6 years of benefits that they can each access. So if Daryl needs care, he uses up his 3 years of benefits at $3,800 a month, then he can start dipping into Ellen's 3 years of benefits. So the average claim is a little under 3 years. But we don't, well, the problem with averages is that means that that's the average, but that means almost half the people had a shorter and almost half the people had a longer. So the shared care rider allows us some wiggle room to say we don't know exactly how much either of them is going to use, but if they're more like the average, One of them might use a little more than their 3 years, the other might use a little less, but we're covered for on both of them the average amount of benefits that somebody will need. And again, I mentioned the costs are increasing, so we did look at an inflation rider, and we looked at the 3% compound inflation rider. One of the things in recent pricing is that the 3% compound inflation rider on long-term care policies is much more cost-effective than the 5% compound inflation rider. 5% compound inflation rider is kind of hard when no one's earning 5% anywhere. And from the 5-year statistics on expenses and how costs are increasing, it may be slightly overkill. And so again, this policy is designed not to cover every conceivable contingency or detail, but to say on the average, or using our best guess, this might cover 3 of the 4 places I might need care, and where 70% of the people are receiving care. So it's a great base, a foundation for planning for long-term care coverage. Now, what does it cost? Well, there's 3 different designs out there today. There's more, but the 3 primary are going to be illustrated right here. So John Hancock has a long-term care policy that has an annually increasing premium. So every year the premium goes up slightly. But as time goes on, the policy can earn flex credits, which you can use to offset or reduce some of those increases in the future. And I'm going to talk more about that here in a second. Transamerica has a policy design where the premiums increase by 3% annually. It's a fixed increase. Their premiums start off the lowest, but they're increasing every year. Mutual of Omaha, their policy is designed as a level annual premium. They have the highest premium of the 3, but theirs is designed to stay level. Again, not guaranteed, but it's designed to be a level premium going forward. So the John Hancock policy, I think, has the potential to be more consumer friendly. I'm used to things increasing every year. Health insurance, auto insurance, their phone bill, cable bill. There's not many things that, unless, there's not many things in life that we expect to stay exactly the same. And so I think this policy has a potential to be more consumer friendly because it's designed to have the little increases that we get used to. So they're little, they're small. But then we have this flex credit that can help offset premium increases. So what does it look like? I say, when is a dividend not a dividend? It's when you trademark it and call it a flex credit. That was my opinion there for 30 seconds. But what it's designed to do is the longer you have a life insurance, or the longer you have a whole life insurance policy or an annual renewing term policy, those policies may earn dividends that you can use to either increase coverage, reduce premiums. Most of the time, especially with annual renewing term, the premiums go up every year, but you may have a dividend that you can use to reduce those offsets. Same idea here with the flex credits. So the flex credits are based on the earnings of the insurance company. Again, same as with a dividend on an annual renewing term policy. Claims experience, again, same thing. Dividends are based on money coming in and money going out. Flex credits aren't any different. And time, how long you own your annual renewing term or your whole life or your long-term care policy, you earn more, you have a larger balance of dividends or flex credits. So all of those things add to what you can potentially use a policy for. So Daryl and Ellen, they have their policy design like we talked about, $3,800 a month, 3% compound inflation, 3 years of benefits with shared care, and a 90-day elimination period. The John Hancock illustration, to start with, assumes that they are going to have a 6% earnings rate. And before you start commenting on that, hold on with me for one more slide. So they have a 6% earnings rate, but they also build in that they assume on the illustration that they have a 10% higher claims experience than they've priced into the base policy. And so at age 53, there's that policy premium, $28.10. By age 63, the annual premiums have increased to $38.44, but because of earnings, claims, and time, the flex credit for that year grew to $940, so kept the net premium to $29.04. So over the course of 10 years, premium did increase a little bit at age 73. All of these things have increased. The monthly benefit has increased by the 3%. The policy limit has increased by the 3%. Policy premium designed by those annual increases. The flex credit has increased again because now we have more time. And so the net premium staying at $29.28. After 30 years, we're getting even more benefit of time. And so the flex credit is actually a little bit more, or a little bit, has grown even more. And so the net premiums actually come down from the original. And so, yes, question is, these all hypothetical numbers? Yes, because they're all projections going forward in the next 20 or 30 years. A flex credit is like a dividend. It's a projection, but not a guarantee. So it's just like dividends on a whole life policy. They're based on the actual earnings, based on the actual claims, and the actual amount of time. At age 88, it's projected that the flex credit has grown so large that the net premium has gone to zero and zero. Now, as I said, before anybody starts stamping their feet saying 6%, I tend to agree with you. So I like running an illustration that shows a different number. Same policy, but assuming 4% earnings, which I think is much more realistic than 6%. And another 50% higher claims than their number of 10%, so I like 15%. So we're giving, the first option is that hypothetical sort of, I don't know if I'd go with best case scenario, but let's call it best case scenario. I think it's pretty rosy. I think this one's much more realistic. So at age 63, that flex credit isn't as high. The premiums increased about the same amount, but the flex credit is $514 instead of, I think it was 900 and something before. So my net premium actually did increase somewhat. After 20 years, my net premium did increase to $42.76. At age 83, my premium's almost $5,000. And at age 88, now I'm starting to get even more benefit of the time, and my premium starts to come down again. And even under the 4% and 15% higher claims, by age 93, it's expected that I don't have any out-of-pocket premiums. So both of them are projections. Which one's right? Neither one of them is going to be right, because all of these are changes to how the, what that flex credit is going to be. Not any more so than the projection of a whole life policy or an annual renewing term policy that pays dividends. They're guesses, but we know that neither of those are going to happen exactly like that, because life isn't that straightforward. But there's an idea that this policy, with differences, premiums might increase in 30 years to about $5,000 and possibly come down. Transamerica, premiums increase by approximately 3% each year. And so this is how it increases. Annually, annually, annually. There's no decrease. There's no nothing. Oh, question, are these premiums per person or for the couple? This is for the couple. So going forward, if you have a 3% increasing premium every year, it looks pretty much like this. It's just going to keep increasing. Policy benefits do. So started off lower, but over the course of time, maybe the highest premium design. And Mutual of Omaha, third policy design, designed to be level, not guaranteed, and so it's hard to say which one is better. Would we rather have something that I know increases a little bit and so I'm never going to get a letter that says 20%, 40% increase? Do I take the one that's higher and just assume that may have that going forward and hope that that's what it is going forward? Understand I may be paying more than compared to other options, but it's designed to be level. And again, this is where you come in. This is where you're working with us, working with the clients to try and figure out what's the best fit. And I do have some questions coming in. If I don't feel I can quite do them justice here on right now, I will get back to you, and I'm going to see more, see if I have time at the end possibly to answer some of these. Martin asks, what happens to policy if the benefit is fully paid out from claims but the insured continues to live? Then really nothing. There's nothing left. The policy is exhausted, so it just sort of fulfilled its goal of having that there. If there was the shared care on it, then you could have used up your share of the benefits of the policy and then started to access partners or spouses. So we have Eric and Christine. They're both age 53. What a surprise. That works out really well. They have good retirement income, but they have quite a bit more in qualified accounts. So they don't see that their money out there is as liquid or easy to access as Darrow and Ellen did. And so they're more interested in what I call the 80% rule. So what is the 80% rule? When we talk about insuring things, I think we should insure catastrophic losses. We should insure the big things. So we insure our house, but we don't insure this house. We insure this ring. Of course, we don't insure this ring. We insure these computers. We don't insure these computers. So when we start looking at the costs of care, and so the home health care, all of the other numbers are pretty normal because they're care in our home, they're an assisted living facility. They are sort of good stand by themselves numbers. But when we start looking at the costs of nursing home, the costs of the skilled care, when you start looking at stay in a nursing home, the reported numbers and expenses include things like 3 meals a day. Because if I'm getting care in my home, well, I'll make a peanut butter and jelly sandwich. If I'm in a nursing home, somebody else has to make me that peanut butter and jelly sandwich, and I have to pay them for that. Laundry. If I'm at home, I do it at home. If I'm in a skilled facility, I don't have access to their industrial laundry machines, and so I'm getting charged for a number of different things within the reported numbers of skilled care that are basics that really I need to pay for, your clients need to pay for, the insured needs to pay for, whether they were living at home or living in a facility. Because we have to pay for food if we're out at a picnic, have to pay for food if we're prepping in our own kitchen, have to pay for food if we're eating it in our recreational vehicle, and we have to pay for food when we're in a nursing home. So all of those things are, I have to pay for that myself anyway, so I don't know that that's an insurance number that I need to pay for extra insurance to pay for my meals. So things that I have to pay for myself, generic medications, laundry, meals, I really should plan for it. Utilities, well, if I'm at home, I have to pay for my utilities at home. If I'm in a facility, still have to assume that no matter how long I'm alive, I have to pay for my meals, and so that's just a normal budget. And so by moving from my home to my assisted living facility, and the averages are $7,500 a month, my numbers are that 80% of that cost of care are for the extras, what I have to be from and what I have to pay for being in a facility, not my normal living expenses or my day-to-day normal expenses. So for these clients, we looked at what is 80% of those, the full cost of the nursing home. $7,200 a monthly benefits. Same other rest of the policy design, 3 years of benefits, shared care, 3% compound inflation rider, pretty much all the same, except now instead of we're covering 100% of those first three, now we're covering up to 80% of the skilled care. And if I only need $3,800 for 1 month because it's in my home, great, I can use it, and the other monies that I don't use from that month stay in my pool of benefits. But if I need to go right to skilled care, I know that I have that $7,200 a month available. And so what are the premiums? $5,365 that starts off low and increases. $8,000 that's projected to stay level. $5,324, another one that starts off low, increases, but could have flex credits to help offset the increases later down in the policy. And so our last couple, Steve and Maggie, they're also age 53. What are the chances? These three 53-year-old couples all living here in Florida. Wow, what? Okay. They like the idea of long-term care. Their advisor has stressed the importance of needing some sort of long-term care plan. But they are a good fit for the hybrid policies. Hybrid policies are a joint linked policy. It's either an annuity with a long-term care benefit or a life insurance policy with a long-term care benefit. It's great because it can do a number of different things. It can provide those assets for income if you don't need it for long-term care. It can provide a death benefit if you don't need long-term care. So it can carry you through different stages of life, but provide lifetime benefits throughout the policy, but may pay out for different things. But it can all be linked to one policy, and we can even have one policy where Steve and Maggie can both be on the same plan. So Steve and Maggie, they're ideal clients for the hybrids because they have some net worth, it's pretty liquid, so they have the ability to not pay an ongoing premium. They have the ability to write a single premium and say, we are getting close to our retirement. You know what, we are really big. We want to get this set up and done. We don't want to, as I get closer and closer to retirement, I see that my income is going to stop coming in this pocket, so I want to reduce the number of things that I have to pay out for from my other pocket. So if we can write a single premium, get this set up, we're interested. So we looked at a $95,000 second to die life insurance policy. And you're probably saying, Mark, that seems like an odd number. And you're right, it is kind of an odd number. But we work backwards. Because with this $95,000 second to die policy, we can accelerate that $95,000 at 4% per month, which gets us to $3,800 a month, which is the amount of coverage that would cover our home health care, our assisted living, our adult daycare. So I work backwards to get us to that $3,800 per month per insured. And because Steve and Maggie are both people on this policy, if they both needed care tomorrow, they could each get $3,800 a month in benefits from this policy. So a total of $7,600 per month if they both need the care. And This policy has a 3% inflation rider. With some of these, the hybrid life insurance policies, and especially the survivorship policies, not all of them have always had good inflation rider options or easy to understand ones. And so this is a newer design where it has the 3% inflation rider attached on this second to die policy. So it's not the, so it's the life and it's the long-term care benefit rider that's increasing, but not the life insurance component. So option one, $95,000 second to die policy with a 50-month rider. So basically doubles the amount of benefits they could receive. If they never need it for long-term care and pass away, their beneficiaries receive $95,000. If they need it for long-term care, they can receive $190,000 in total long-term care benefits today. With the 3% compound inflation rider, it's a $94,000 single premium. Not a lot of life insurance, a lot of long-term care benefits. That's what it's designed for. Not as much as the other one. Not as much long-term care as the one below it. $95,000 second to die policy with unlimited long-term care benefits. One of the very few places where we can even find unlimited long-term care benefits anymore. I don't know of anyone who still has it on a traditional long-term care policy. Older policies might, but the current ones, I'm not aware of anybody who's still offering one today. So unlimited long-term care benefits with the 3% compound inflation rider. That policy has $129,000 single premium. You're going to say, Mark, that looks like more than the death benefit. And you're right. But it's that hybrid. It's the, if I never need it, well, sure, I paid $129,000 for my kids to get $95,000. But I know that I wasn't going to not receive any benefits from it. But if I did need it for long-term care, I basically have an unlimited amount of benefits. So, insurance is about transferring risk. That's what we're doing here. Do I want to say 94 can transfer $190,000 of risk, or 129,000 can transfer potentially an unlimited amount of needing long-term care risk? 30 years later, there's Steve and Maggie. That policy still has $95,000 of life insurance. Remember, the increase is not on the life insurance component, but the long-term care benefit on what was the 50 months shared has grown to over $500,000. Not over, not quite, close to $500,000, $447,000. And if they needed care, they could each receive care of $89.55 per month. That's almost $18,000 a month they could receive benefits for them. Or option two, same monthly benefit has still grown to $89.55 a month, but it has that unlimited long-term care benefit option. They can receive the $89.55 reimbursed for expenses for an indefinite period of time. Pretty neat, because we're taking someone who may self-insure anyway, someone who says they have the ability to self-insure. But if you put away $120,000, it's going to grow. And in 30 years, it's going to grow to some number. But if you need care at that point, you can set it aside for a rainy day or set it aside, but really, once you use that up, you're not going to not receive care. You're not going to care for your spouse or partner. You just start dipping into other assets. So this is a way to take some assets today, take this rainy day fund, what I might otherwise self-insure with, and transfer the risk to the insurance company and provide these much larger pools if you need it for long-term care benefits. So with the hybrid policies, you can have your cake and eat it too. You can have that policy where I'm putting aside some of my assets, and there's going to be a annuity value. Or long-term care benefits that's much larger than that. Or I'm going to put away some assets and there's going to be a death benefit that passes either at my death or at the second death. And there's going to be a much larger long-term care pool after that. If I need long-term care, there's going to be that much larger pool for care. So they're ideal for people who have the ability to write that check, people who were going to self-insure in the first place, but if they do need care, there's that much larger pool, and they can be sure that somebody is going to get something from that policy. So thank you, everybody. I had a lot of questions coming in here right at the very end, and I'm about out of time. So I am going to print all these off and get back with everyone here in the next day or two about your questions. So thank you for everybody. Wow, they just keep coming in. So we talked about pricing and claims and a few case studies. We have one more webinar this year. It's in December. 'Tis the season of giving and layering. So we're going to talk about life insurance and different things about people who want to be charitable at the end of the year, either to charities, their alma maters, to their kids. And so that'll be our last one for the year. And so I hope everybody joins me. What else? For anyone who's new to our webinars or LLIS, we work only with fee-only advisors. We do insurance. We don't do what you do. We work with you to save you time and save your clients money. We do a lot of pre-underwriting ahead of time to avoid surprises. There's lots of tools about long-term care, talking about long-term care, hybrid policies on our website. We are proud sponsors of a number of different fee-only organizations, and Jerry and Joe were just at the ACP conference last week and said they had a great time. And we have specialists in all the different solutions: life, disability, long-term care, annuities, and the hybrids. And if we're able to help you and your clients with a policy or an application for them, we keep you as the advisor up to date and in the loop with our AIM system. And we're here now to help, and we're going to be there in the future. We have 3 people on our policyholder service team. From their experience, I think there are insurance companies who don't have 3 people on their policyholder service group. So we're here to help you and your clients with their policies, whether it's now or in 10 years or 20 years, or like I looked at with the hybrids, even 30 years from now. And so, yes, this slide does say questions. I will I will get to all of the ones that have just come in the last few minutes, and I will be emailing with you shortly in the next day or two. So thank you all so much for attending. I hope you enjoyed it. I had a lot of fun putting this together, and we'll all watch the elections returns tonight, and then we can get back to watching commercials for anything else but political advertisements. So thank you all very much.